Well, moving on to the rates debate, and St. Louis Fed President James Bullard saying he expects the central bank to stop its so-called front-loading by early next year. Speaking with Bloomberg, he said the goal is to move to a, quote, meaningfully restrictive level, not go up forever. Our next guest says the Fed's aggressive rate hikes so far this year have ended the era of free money and exposed a concerning dynamic throughout capital markets, and that's zombie stocks. Let's bring in David Traynor, New Constructs founder, CEO. David, good to talk to you today. Let's start by talking about how you define zombie stocks.
Zombie stocks are companies that are burning tons of cash and have little cash on hand to sustain that burn, less than 24 months. They typically also have a negative interest coverage ratio where they're actually not making enough pre-tax profit to meet their interest payments or their debt payments. So it's just a matter of time before they either have to take on some very expensive additional financing if they can find it, or they go bankrupt.
So to what extent have we seen the number of those zombie stocks accelerate as you point out, as we've seen the Fed's tightening cycle?
Yeah, I mean, I think, for a while, there was no such thing as a zombie stock when there was effectively an infinite amount of liquidity out there. I mean, companies were getting funded for really no business plan at all. They could just lose money into perpetuity. And as the Fed has pivoted and decided they're no longer going to sort of continually inflate the economy, that they actually need to take some air out, well, the limit to the funding available has created, we see at least 300 zombie stocks out there in the market. And we've highlighted up to this point a list of 19 that we think are in the most imminent danger. And yeah, that number's only going to get larger, right? Because the cutoff point is 24 years of cash to sustain the cash burn. And as each month that passes, there are sort of more stocks that are coming onto the list.
So let's highlight those 19 that you've honed in on. A lot of familiar names: Snap, Rivian, AMC, GameStop, among others. Who's in the most dire position as far as you see it?
Well, some of the ones we put on there first, like Carvana, Fresh Pet was on the list. We took it off once the activists came in because that was basically about to go under. Snap is a good one. Robinhood is a good one. These are businesses that really aren't making any money and really have no real potential to make money, and their valuations are still really expensive as well. So it's almost hard to say which one is worse because none of the business models, in our opinion, are viable. And, Peloton's another one. We see, shortly after we wrote our zombie stock report on Peloton, the CEO effectively came out and agreed it is a zombie stock, and they got 6 months to prove that they're not going to go bankrupt. So those are some of the highlights, but none of them are good businesses at the end of the day. And that's the sad part here, is that they probably should have never gone public, and they should never have been allowed to take as much shareholder capital as they did.
David, there's one name that you flagged that's getting a lot of attention today, and that is, of course, Tesla. I mean, you point out that you think the cash flow expectations baked into the stock price are unreasonably optimistic. A bit of a mixed message coming from Elon Musk yesterday about where that demand picture looks like moving forward. He also sort of dangled that buyback of $5 to $10 billion in there for next year. What do you see in terms of where the stock could go? How much lower? And is this defined as one of those zombie stocks?
Well, the only reason it's not a zombie stock is because Musk has raised so much money that they've got a lot of cash on hand to sustain a burn for a long time. Now, the real question for us, though, is for how long can Musk sustain the super high expectations? Look, I mean, mixed messaging, Musk is the king of mixed messaging, right? I mean, that's part of why he's not been hauled into court more often, because he says, oh, yeah, we're going to have full self-driving by next year, and maybe probably, or if not next year, in the next 6 months, blah, blah. He's kind of constantly dithering, never making really matter-of-fact statements. And that's what allows his legal team to go to the regulators and say, well, yeah, he said this here, but he said something else here. It's all a bunch of gobbledygook, right? Unfortunately, too many investors still really pay a lot of heed to it. But I feel like the tide is beginning to turn. More and more folks are sort of starting to see, hey, there's been a lot of promises made and not a lot delivered. And some of these stunts are beginning to be seen for what they are, as stunts. And so, this whole Twitter deal is one that's really got a lot of people scratching their head. if Tesla's such a great company, then why are you spending so many billions of dollars to buy something that isn't so great? How does that fit into the bigger plan? How are you focused on making sure Tesla doesn't continue to sustain serious market share losses now that the incumbent automakers are ramping up production? Tesla had success when there was no competition, and they are not having any success. They're losing market share as the competition is coming online, and that competition is set to ramp up huge. So it's going to be really difficult to make a straight-faced argument on the merits of the underlying business of Tesla. And I think that's why Musk spends so much time talking about periphery items, because he really wants to distract people from the core issues.
Well, also interesting to hear Elon Musk, address the Twitter issue head on an earnings call for Tesla, which probably points to how jittery some investors are. David Traynor, always good to have you on the show. New Products founder,
Thank you.
CEO, New Constructs founder, CEO.